Hi, this is Richard Vague with Tycos. Who benefits from the Fed's interest rate cut? The Fed just cut interest rates by a half point, so let's look at the impact of that. Bottom line, the winner is the government itself, and to a lesser extent, the bottom 90% of U.S. households, and the losers are primarily the wealthiest 10% of households and all the U.S. Treasury holders in foreign countries. You can think of the whole thing as really a redistribution exercise. Rate increases and rate cuts don't make things appear and disappear. In large measure, we're redistributing, a chunk of income from wealthy households and to the government. But overall, the impact is not as much as you might think, at least over the short run, since so many loans and securities have fixed rates. And the process for determining the impact on the private sector of a change in rates is very inexact, since we can only estimate if and by how much a given bank reduced its rates on its different types of loans to its various borrowers. But here's our estimate of the rate cut impact over the next 12 months, what you might consider the cash flow impact to each sector. We do this without taking into account any impact of the rate cut on stock prices because when it comes to stocks, you never know. But first, the federal government will save $30 billion over the next 12 months, and state and local governments will save another $9 billion. Pretty good, right? But this accounts for the fact that much of the Treasury debt has a maturity of well more than 1 year, so there won't be a benefit over the next 12 months on those. If we project the impact of all government debt, as if all government debt were to be repriced down by a half point, the benefit would be $112 billion. Second, the bottom 90% of households benefit a little bit, but not as much as you might think. They actually hold more short-term assets than short-term debt, but a big chunk of those assets are in the form of pension assets. So reduced income on the bonds in their pension portfolios don't directly impact their cash flow. But they do hold their debt directly, of course, and a decline in rates on their short-term debt benefits them by $7 billion, or under $100 per household over the next year. Most of their mortgage debt has a long-term fixed rate. As those loans and other long-term debt matures or is refinanced, the full benefit to households would be $25 billion a year, but that'll take time to get to that level. Next, the wealthiest 10% of households will see an estimated $18 billion reduction in their interest income. Again, as their assets mature and roll over, that reduction will grow to $78 billion. The rest of the world will also see a decline in interest income of $28 billion, since they are net holders of U.S. Treasury securities, and that reduction will grow to $56 billion as those treasuries mature and roll over. As an aside, the rest of the world is a net holder of treasuries because of our gaping U.S. trade deficit. We buy things from them with dollars, and they have to do something with those dollars, so they largely end up parking those accumulated dollars by buying U.S. treasuries. Two important notes. Businesses actually see quite a large benefit from a reduction in rates since they are net borrowers, so they're winners here too. And that'll bring a lot of short-term gain. But here's the important thing to note. Over the course of a relatively short period, that benefit really makes its way to households, primarily the wealthiest households, in the form of dividends and distributions. And our analysis assumes that really largely occurs, and there's very little benefit that kind of is retained by businesses. You see that very clearly when you look in aggregate at what we would call the macro sector balance sheets of the entire economy, businesses, households, the government, et cetera. You know, the business sector on a cash flow basis doesn't end up retaining a lot of profitability. That really makes its way to households. And most of the income and wealth in the country really resides in the household sector. You see that in the Fed's and the OECD's integrated macro accounts, or IMAs. So that's just something to keep in mind. And similarly, we also assume most financial institutions, including the Fed itself, will manage their assets and liabilities in a way that relatively quickly either distributes the benefit of a rate change or neutralizes the cost. The people who will really have to scramble over the short term are highly leveraged bond funds and the like. And at a granular level, there will be a lot of short-term pain or gain there. But again, we assume they will manage their assets and liabilities in a way that relatively quickly distributes the benefit or neutralizes the cost of the rate change, especially when we consider that sector in aggregate. So that's the story. The government and middle to lower income households will win. The rest of the world and the wealthiest households will lose. And the impact over the short term won't be as big as you might think. If your analysis yields different results than ours, let us know in the comments. Thanks.